So good afternoon, everybody. I'm Zach Fry, the program manager here at BWC, and want to thank you all for coming to today's episode of the BWC Dialogues with the future of tokenization. We have a great and really timely conversation lined up today, so I will be brief in my introductions, but before I hand it off, I wanted to let you know there will be plenty of time for questions at the end of the conversation. So I will ask you to write your questions in the Q&A function, and then at the end of the conversation, I will let you unmute yourself and ask the question to the speakers yourself. With that, I want to introduce our speakers today. We are joined by Greg Johnson. Greg is the founder and CEO for Rubicon Digital Assets, a professor at NYU School of Professional Studies, and he leads our Bretton Woods Committee work on tokenization. He will be joined by Carlos Domingo. Carlos is the co-founder and CEO of Securitize. He has more than 25 years of experience in innovation and digital transformation, and right now Securitize is certainly at the epicenter of tokenization work. So we're very excited to hear from you both. Thank you both for being here. And with that, Greg, I will hand it off to you.
Well, Zach, thank you, and good afternoon to everybody joining us, or good evening as it applies to some of our international viewers. Zach, my thanks to you and everyone in the Secretariat, as always, for putting together these dialogue series. A lot of work goes on behind the scenes to curate the guests and to put the content together. And I'm particularly excited about this conversation today. Just as a reminder, at Bretton Woods, we're an organization that has really become the preeminent nonprofit that's dedicated to effective global economic and financial cooperation. And if there was one subject in the headlines today that could speak to advancing that work, the mission of Bretton Woods Committee, it may just be the subject of tokenization. And if we're going to talk about tokenization, there are few companies and few CEOs in the industry right now that are more in the epicenter, as you alluded to, Zach, in the world of tokenization, connecting the dots between traditional financial services, traditional banking, and the new digital world in tokenization. And Carlos, on behalf of the executive team and the board, I just want to say thank you again for joining us here this afternoon. It's good to have you with us.
Thank you, Greg, for the invitation for attend this very prestigious committee and give my views on tokenization.
Well, let's jump right in, if you wouldn't mind. Please, for a lot of our members, they have incredible subject matter expertise and a wide range of topics, but tokenization may not be one of those just yet. Would you mind telling the origin story for Securitize and maybe talk a little bit about how you ended up getting here? You took the long, winding road, so to speak. So I'd love it if you could maybe fill in a little bit of your CV for our audience and also the origin story, if you wouldn't mind, for Securitize.
Sure. I'm originally from Barcelona, from Spain. I've studied computer science in Spain first, and then in Japan at the Tokyo Institute of Technology. I have both a master and a PhD in computer science, and I've been working in technology all my career in various parts of industry, in telecommunications, back in the days in the dot-com space, etc. And then in 2016, I kind of stumbled upon blockchain, and that's really when things started. Like Bitcoin existed before, but that's when the public Ethereum blockchain launched, which is arguably the blockchain that enabled functionality and applications to be built on top of it, as opposed to like the Bitcoin blockchain. And that's the time where, I don't know if people remember, there were the so-called initial coin offerings and ICOs, where people basically were selling these tokens that were representing some sort of an economic interest in a project that people could purchase to participate, and then in some cases do something with the token, etc. So I was fascinated about it because you basically had a mechanism where you could very easily invest on a project through a token, and those tokens then got listed and they were trading in exchanges. Whether that was legal or not is a completely different discussion, but nevertheless, that's how the industry started before the SEC kind of a step in and tried to set some rules around this process. And so, as a person that had been in the tech industry all my career, it's very difficult to actually invest in startups or in VC funds. There's a lot of friction in the investment process, etc. And then those investments tend to be very illiquid. So I somehow look at this technology, these public blockchains. Ethereum at the time was the only one that was around, really. And the concept of the token as a way to represent ownership into something in a very efficient ledger that you move the ownership of the underlying whatever the token was representing. And I I had this kind of intuition, not just myself, but a number of people in the industry, that this could really apply very well to securities, right? So traditional securities, especially private securities, public as well, but for different reasons, they are this friction in how you invest. There's
Sure.
with lack of liquidity, with settlement times, counterparty risk, etc., that this technology had the potential of solving. So we had this idea of, why don't we tokenize a fund? And by tokenize, I mean that, take an LP interest on a fund and issue a token that is a representation of the beneficial ownership on this fund, and then try to use the technology as a simple way of, issuing the security, represent the ownership, and then potentially provide some liquidity through a superior settlement process when the token, changes hands, which the token security. And that was the origin of Securitize. We obviously, at that time, there was a lot of people that were trying to issue tokens that were not securities. We, from the very beginning, took the view that if the token represents the LP interest of a fund, it's essentially just a security that is represented on a different ledger. All securities are represented in a ledger somehow. Could be Excel, could be captive, or it could be, share certificate,
Papyrus,
could be DTCC, but at the end of the day, there is a ledger somewhere that says you own this, and blockchain just happens to be a better ledger. So we took this view that these things were securities, and went into, as you said, the long-winded road of, the whole securities regulations and how you could actually make securities regulations work around this superior ledger technology. And that was the inception of Securitize. So from actually tokenizing a fund that we set up ourselves, we then kind of spun out the underlying tech and then created Securitize launching, incorporated the company in November 2017. So we're about to be 7 years old, and we've probably been in this space of tokenization in particular, just doing this longer than anybody else.
In tokenization years, that's like 100 years to a normal company. So that's quite a milestone. Your intuition about this being a good place to focus your time and to found and so forth has proven correct. One of the things that's on the minds of most of our audience today is maybe learning a little bit more about the work that you're collaborating with BlackRock and the BIDL project. I know that's on the minds of most people, and it's certainly probably one of those screening endorsements about tokenization, the future of tokenization, when you think about the world's largest asset manager. Would you mind speaking a little bit more about what exactly is a tokenized money market fund, some of the attributes that go into it? Maybe take us through that a little bit to the extent that you can, please.
Let's maybe take a step back and talk about like tokenization generically. What does it mean? So
please.
As I mentioned, any ownership into any asset requires recording the ownership of the asset on some sort of ledger, right? Anything, like if you own a paint, it's not recorded anywhere, but you have physically the paint at your home. But if you own a house, then there is a deed that is recorded somewhere saying that you own the house. If you own securities, then those are recorded by the issuer somewhere, or they're recorded by a transfer agent, or if they're publicly traded, they're recorded by the DTCC and the brokerage houses, etc. So there's always like a ledger involved in recording the ownership of an asset. And essentially, tokenization is the process of basically issuing what is called a token, which is just basically a technical term that people use on the blockchain space, which means is a proof of ownership, if you want, to an underlying asset that is recorded on a blockchain. And what's a blockchain? Because that's just even taking a step backwards. A blockchain is nothing else but a very efficient ledger that is public. Means anybody can actually use it. It's not like private, controlled by some people. It's accessible publicly, like the public internet is accessible to anybody. That happens to be distributed, so it's not controlled by anybody. There's a number of people that collectively maintain the integrity of the ledger, and that is cryptographically secure. So it has you can trust the content of the ledger as being correct without assuming nobody has tampered with and nobody has modified without the permission of anybody. So it turns out to be a really good ledger for recording things. On top of that, it has technology on top of it to create rules around how people record or transfer ownership on the ledger. This is a technical term called smart contracts, that essentially they are rules that allow you to basically control the transfer of this the records of the ledger in a programmatic way. So it turns out that when you want to record the ownership of a real, like the industry calls to the real world assets, if you want to record the ownership of an asset, there's two ways to do it. One is, the asset itself is a security, let's say a fund, like a money market fund. We'll talk about this in a second. Or you have to securitize an asset, which is a process that exists in traditional finance forever, where you basically are capable of providing fractional ownership and an economic interest in the underlying asset by issuing securities against that entity, and then you have to record the ownership of the securities. So this whole process just happens to be of tokenization. Is just basically issuing beneficial ownership for the most part of securities on this public distributed ledger that is cryptographically secure, that makes it more suitable for that particular activity. So that's what tokenization is. Now, in the case of BlackRock, I think first I want to explain a little bit how we ended up working with them, because maybe that's relevant. So we started
for sure.
in 2018. My background is technical. As I mentioned, I have a PhD in computer science. So I approached the problem from a technology perspective without realizing about the regulatory complexity of actually issuing and dealing with. So maybe I had a vision, but I was very naive in the sense of how easy it was going to execute this vision. So eventually,
you're not alone, Carlos. You're not alone in that front.
I think a lot of people have found this problem. So technology solves part of a problem, right? But then you have to comply with regulations, which is a whole different problem. So we ended up spending a number of years basically getting all the necessary licenses to be able to provide comfort to traditional finance firms like BlackRock in this case, that we could legally issue securities, record them on this public distributed ledger, and then provide all the, if you want asset servicing required for these securities, right? Like how do you transfer them, how you do redemptions, how do you do all the sort of things, how you pay dividends on chain, etc. So we got a license called Transfer Agent, which I'm pretty sure here anybody familiar with financial services have heard of it. There's very, very large companies that are transfer agents, with computer shares or BNY Mellon on the State Street, etc. So we do have essentially the same license, but just operate with a completely different ledger technology. And then subsequently, we actually got a broker dealer that allows to sell these securities that happen to be represented on these ledgers, on these blockchains, and then something called an alternative trading system, which is basically a way to create an order book to do a secondary market transaction of this ledger, and following a specific settlement process that the SEC approved in 2021. So once we have all these technology as well as the regulatory coverage for the end-to-end process, that's when we kind of started getting the attraction of the traditional finance people that obviously saw the value of tokenization, and in particular, Larry Fink, who is one of the founders and the CEO of BlackRock in 2023, started talking about how they saw tokenization as the future of asset management, because at the end of the day, an asset manager, a lot of what they do obviously is raise money and invest money, but they also have to record the ownership of everything they
That's
have,
right.
move it around, and that turns out to be a very complicated process with a lot of intermediaries involved, with a lot of reconciliation errors, manual processes, etc. So they saw this as a potential disruptive technology for an asset manager in the way that they basically manage securities and serve those securities and offer them to customers. So ultimately, we started working with them, and then the first project we chose is actually not technically a money market fund. Money market fund is a regulatory term, but it's essentially like a private fund that contains short-term dated treasuries, less than 3 months, and repurchase agreements, which is equivalent to what a money market fund will have. It just happened to be a private fund registered in the BVI. So, and then the reason we chose this project is because if you look at the crypto space and what has been the most successful use case of tokenization is actually the dollar.
Stable coins. Yeah.
Right.
Yeah.
Well, the dollar in particular, right?
Yeah.
So a token that represents a stable coin is a token that represents a dollar. And today there is around $160 billion of digital dollars, if you want to call it that way, or tokenized dollars. that are part of the crypto ecosystem, and it's one of the biggest parts of the ecosystem and one of the fastest growing. So that has been a super successful use case. And then a money market fund is basically the closest thing to a dollar, right? Because you're tokenizing short-dated treasuries. So we felt that the same way that in traditional markets, people use treasuries to, for treasury management or for collateral management, etc. It makes sense that in the crypto economy, people, instead of using tokenized dollars, they use tokenized treasuries to do the same thing. So we created this product called BIDL, which BIDL stands for BlackRock
USD. Yeah.
Liquidity Fund, Liquid Digital Fund, I think, Digital Liquidity Fund, sorry, which is essentially a tokenized treasury fund that has a stable value of $1. So each token, it's $1. We then issue this on a public distributed blockchain on the Ethereum blockchain. So when you want to invest, you get your tokens that represent the dollar, the treasury, sorry, the tokenized treasuries. Those tokens are transferable peer-to-peer across whitelisted participants. These are securities. Obviously, they cannot just move around like other crypto assets move that are completely anonymous and permissionless. But once you are part of the ecosystem, you can freely transfer the fund, just basically by sending the token from a wallet to another wallet. That's already a major advantage. If today you have a money market fund with JP Morgan and you want to move it to Morgan Stanley, with that, it's going to be a convoluted process of two banks synchronizing their ledgers and agreeing and etc. So there is a lot of friction on moving securities in traditional economy. Here there is not. And then second, it has actual redemption against USDC, which is one of the most predominant and the US-based stablecoin. There's another stablecoin that's larger, which is offshore. So there's a lot of controversy around that. But USDC is the US one, if you want. It's issued by Circle, which is a US company. And then we have a mechanism where we can basically, when you want to get out of the money market fund, you can just send your tokens to one of these smart contracts that I mentioned before, and you will receive this stable coin that represents $1 that then you can use it for whatever, payments, for trading, etc. So this showcases also one of the advantages of having, of tokenization, which is you have on the same ledger securities and cash with the same representation on the same ledger, right? Like if you think about the issues you have in traditional capital markets when you settle a trade, is you have to move the security and you have to move the money. And
that's
those
right.
are sitting in different ledgers and they need to be synchronized. And that sometimes doesn't necessarily happen in an efficient way. That's why settlement times are sometimes inefficient. It takes, 1 or 2 days, or it could take longer depending on the type of security. So in crypto, you have these public blockchains that have tokens under the same technology representation, one that represents $1, one that represents, in this case, a money market fund, and you can swap them in a very, very efficient way.
Well, I mean, it's certainly an important breakthrough for the industry, and you know that, and you've been quite humble about this for some time. But as you see, could you elaborate a little bit more and speak in general terms about use cases that you think are really, significant? I can think about, on-chain treasury, management and things of that nature, and collateral, facilitating, collateral for trading, et cetera, et cetera. But can you dig in a little bit more on some of the use cases, not just for the collaboration with BlackRock, but as you see the industry kind of today and evolving a little bit, if you could do that?
So more generically, like about crypto, it's just a different economy that has emerged, right? And it's completely disconnected from the traditional economy. It's an economy on its own. It's its own ecosystem with its own participants, with its own, money and etc. So, that economy today lacks the same products that are available to the traditional capital markets. So tokenization is a way basically to take a traditional financial services product, in this case, a money market fund, but it could be private credit, which we have done as well, or dollars, as we mentioned, etc. These are like sitting on traditional ledgers in traditional finance. And then you basically inject them into this new crypto economy, which today is like $2.5 trillion in size. So it's already pretty significant. And then you bring these traditional financial services products there in a way that they can actually be used efficiently, right? Because they have the same rails, the same speed of movement, the same compatibility with, the money in those rails, etc. So for us, and keep in mind also in crypto, there is, because they have all these you know, companies that operate in a very decentralized way with what they call the DAOs, which are some decentralized autonomous organizations that don't have ownership, where people vote for taking decisions, etc. Many of those people don't actually have access to traditional rails. They don't have access to a brokerage account with Morgan Stanley to be able to buy a money market fund. And if they do, then the money market fund sits there, but they operate here. So when they want to move things in and out, it's a very inefficient process, right? So we are basically bringing these products into that economy. Treasury management, as you mentioned, is a big thing. So if you are a crypto company and you want to put your treasury in treasuries, in US treasuries, then there's no simple way to do it today unless you move it out and you move it into actual dollars. And as I mentioned, open a brokerage account. Some of those companies will never be able to open brokerage accounts in traditional, banks. So we are providing basically a way for them to actually keep their treasury on chain on their same ecosystem, open a brokerage account with us, which we're the broker dealer for the BlackRock product, and then basically move their treasury, which in some cases of these companies is very large, is billions and billions of dollars, and being able to move it into a yield-bearing product like tokenized treasuries that is very safe as well. So that's kind of like use case number one. Use case number two is what you mentioned about collateral. Crypto obviously is a lot of crypto is about trading.
Yeah.
What it is about creating financial services products that are novel and new, that actually people trade and speculate on them. There's nothing wrong about it, by the way. Like traditional finance, also a huge component is just pure speculation on things.
Of course.
And then because they lack, things like treasuries on chain that they can actually use efficiently on their ecosystem and that move at the same speed that crypto moves. But crypto trading is very efficient because things settle immediately, move quickly, it's 24/7, etc. It's very different than traditional capital market. So if you were to inject something there, it has to work at that speed and those rails. So the middle product from BlackRock is actually a very good, collateral for trading because it's basically a stable value, is safe, is issued by counterparty risk is not towards any crypto company because it's managed by BlackRock, but it's all
BlackRock.
Crypto native, right? It runs at the same speed as the rest of the crypto trading. So you can put it as collateral. If you want to liquidate it, you can liquidate it immediately. If you want to move it to stable coins to trade, you can move it, etc. So that's
well, it's interesting. I can't help but think I've always felt that there was a real derivative play here as well. That there was an opportunity for, derivative product creation and so on and so forth. Is that something that you buy into as well?
Correct. So I think that's kind of like the third use case, I will say, of people that are building derivative products to create things that in some part of the product they're creating rely on treasuries, but they add other functionality, right? So that's the third use case. Sorry, where people are creating these derivative products. So those are the two use cases: treasury management on chain for native crypto companies, collateral management for trading firms and exchanges, and then derivative products that provide other functionalities on top of treasuries, right? Like maybe less liquid but higher yield because they combine it with something else, or different investment requirements than the product that we have, which is only for institutions, qualified purchasers, and 5 million minimum, etc. So
let me pivot a little bit in the fact that, look, I spend a lot of time working in the Middle East and working in London, and you've traveled and lived abroad and kind of understand the global kind of thinking around tokenization. Can you give our audience, which skews a little bit towards North America in most cases in this viewership, can you get a sense of how other jurisdictions view tokenizations, how they might view it differently? Can you give us some insights on that?
Yeah, that's an interesting question. Just for background for the audience, I'm European, so obviously I live in Europe. Besides Spain, I live in Sweden, and I spend a lot of time in England. In the past, I've lived in Japan many years. I studied the Tokenization of technology and started my career there, so I do know Asia very well. And I also live in Dubai in the Middle East and work in Saudi for a year, so I do know the Middle East very well. And obviously now this is my second time in the US. I live on the West Coast and the East Coast, so I think I also get a sense of the variety of tastes in the US between the coasts. So crypto is a global economy, right? And largely precisely because it's very if you want lightly regulated, then it allows them to like be very global, right? The securities industries are not global. Every jurisdiction has different regulations.
Right.
Because tokenization, as I mentioned, for the most part involves issuing and managing securities. Then it has this friction of, complying with different regulations in different jurisdictions from a securities perspective. On top of that, then you have how each jurisdiction is adopting, public blockchains as an actual ledger that you can actually use to represent, manage, and trade securities, right? Which again has different interpretations in different countries, and we can go a little bit more into those differences. But I think it also has the ability, because everything is programmatic, to create a global marketplace for securities, which is something that will be very, very difficult to do in traditional rails, right? Because programmatically you can actually control, depending on who the investor is and in which jurisdiction it sits, etc., how those securities behave or move or comply with regulations, because everything is just software at the end of the day. It's a set of rules program to comply with that. So the securities we issue always are global in that nature, that we serve, investors in any country. We control, rules for, transfer of those securities programmatically, depending on where the investor sits and who the other investor that is receiving the trade is, and things like, I don't know, in the US, for instance, you have something called flowback restrictions, where if you sell securities to a foreign, investor, you kind of allow them to flow them back into a US investor. This is very easy to control, because you just basically put a rule saying, if investor A is in Spain, investor B is in the US, when they try to transfer the token, just block the transfer from happening and don't record any changes on the blockchain. So it has a huge advantage in terms of being able to provide a global economy and a global infrastructure for capital markets. Now, the problem today is where every jurisdiction is in terms of adoption of these things, right? So in the US, there's been a little bit of progress with the SEC in terms of tokenization. There's a proposal out there, which actually which has not been widely adopted, but nevertheless is there, about how you do custody of the securities with a broker-dealer. There is a proposal, well, not proposals, but actual letters from the SEC about how you settle trades on a blockchain, which we actually are approved for that. In Europe, there is something called the EU DLT pilot regime. It's a convoluted, but it basically is a regime. It's a 5-year regime. It says pilot, but it's actually an actual commercial license with some limitations, where it allows broker-dealers to basically use, public blockchains as a ledger to record the ownership of securities, and it allows them to settle the trades on the blockchain without requiring a central securities depositories. Most jurisdictions use central securities depositories as a way to control trades and settlement process and counterparty risk. The blockchain, to some extent, eliminates the need of those intermediaries, and Europeans have recognized that, and it's not required. You can actually settle trades without using, Euronext or Euroclear or whatever of your favorite,
No, I appreciate that perspective. I mean, when you interact with FCA or a MiCA regime, or if you're in the Gulf and you're dealing with SAMA or ADGM, and then you come here to the States, you just realize how wide the spectrum is in terms of how people are approaching some of these novel concepts. You're an interesting person to ask about this, but you mentioned smart contracts and, good old Nick Szabo and the development of the smart contract, if you will. As a technologist, the knock, had been that the smart contracts weren't that smart in this first generation of the crypto space, that maybe they weren't that smart. Do you feel as though the smart contracts themselves are actually smarter? I'm not trying to be too cheeky here, but does that make sense? Do you feel like we've made progress?
Why they call it smart? They don't do anything smart. In smart contract, essentially a set of rules. That's what it is.
Yeah.
Set of rules that is built in at the ledger level, if you want, that when you want to move an asset from one place to another, it goes through this set of rules to determine what do you do, right? So that's what smart contracts at the end of the day are. If you want to issue a new asset, or if you want to, burn an asset, or like, this is a programmatic way of managing assets on a ledger, which is built in natively on the ledger, right? So it's great because it allows you to precisely move things around in a very efficient way, in a programmatic way with rules, etc. But there's nothing smart about it. It's just software. It's a set of rules that you can program to do things with the entries of the ledger and how you want to update them. So that's at the end of the day where they are.
Do you think that there has been some wide-ranging criticism of whether or not, again, we're in agreement, so we're in the same choir here that we don't think they're very smart, but has there been improvement in terms of the tech behind the scenes in terms of being able to scale this tokenization world? Do you think that the tech mechanisms are actually better than where they were from where you sit a few years ago?
The blockchain technology in general has improved a lot the last few years, right? So first, there's a variety of alternatives that exist today that all have different characteristics in terms of, the speed of transaction, the cost of the transaction, etc. There's been a lot of progress, in my opinion, not as much as it should have been, considering the many years that have passed by, in terms of the user experience of actually getting exposed to an asset that sits on a blockchain, because that creates a lot of friction. So wallets are easier today, key management, all these, things that are involved in like holding crypto assets, whether they're securities or not. I think it has improved. I think there's still room for improvement. In terms of smart contracts itself, it's pretty much the same as it was before. Of course, there is different type of like tokens categories and taxonomies and things that you can do with them, etc. But the basic is the same. And by the way, they're not smart, but they're not stupid, right? Like a smart contract, a virtual machine that runs a smart contract is Turing complete. So from that perspective, you could program anything you wanted, because it's almost like as a computer that sits on this ledger that allows you to program the ledger with anything you want to do, right? So whether they're stupid or not is up to what you put there, but most of the time we just don't put too sophisticated things. So
if only we could say that about quantum, but that's for another conversation down the line. What would you say? What would you say? We have many in the audience that are in senior roles on treasury function. Many in our audience have had careers in liquidity management for large enterprises, global enterprises. What would you say about tokenization to get people to kind of lean in a little bit more? Is this something that you feel is going to be ubiquitous to every financial institution? Are we at the tip of the iceberg from your perspective? Is that what you see?
I think that there's all these wild predictions from really famous and intelligent people about how everything will be tokenized and we're going to have $30 trillion of tokenized assets by 2030, etc. I'm actually not in that camp. I think that tokenization, it touches a very fundamental piece of infrastructure, which is the ledger where you record the assets and how you move them. And then there is a lot of inefficient ledgers out there that actually work because people have spent a lot of years building all sort of stuff around to make them work. And then there's all this inefficiency there, which is going to be very, very difficult to displace. So, thinking that, all the stocks will be tokenized, I don't think that's going to happen tomorrow, because the amount of infrastructure you have between central securities depositories, exchanges, and brokers and stuff like that is very difficult to displace. I think that I'm more of the camp of that. This will, the crypto, financial services ecosystem will grow, and at some point will be really, really large, and things will move there periodically, and then there will be this new, capital markets infrastructure and this legacy one, and the legacy one will shrink and things will move there, but not necessarily that the legacy one will adopt this new technology. I think it's very difficult to think that, you will see the NASDAQ running on top of a blockchain the next 10 years. I'm not in that camp. I think that it's much easier to think that there will be a new national exchange that will actually run in a much more efficient way, because it will have a different set of market participants and underlying infrastructure, etc. That I think that these guys are going to go and dismantle everything they have and completely put it in new rails.
I think I probably speak for a lot of the prudential banking.
Computing is the same, right? Like, when you got workstations and then eventually PCs and then server farms and then cloud, there's still a lot of people that run on mainframes. They never actually migrated, right? Because yes, those were better, but they were actually invested a lot of money and time to make something work that runs into these big infrastructures that are very, very difficult to displace. And companies like IBM still serve mainframes, and of course, because nobody's buying new ones, and some of them are being discontinued, then the mainframe market is shrinking, and then these new markets are like growing, right? But those still.
I'm tempted to ask you about the extent that COBOL still runs the world, but we can do that another time as well.
Right? Probably a lot of large financial institutions still run on COBOL and mainframes, right? And that's my point. But at the same time, you have, it's like brokerage firms the same. Like probably if you look at a company like Robinhood, it runs on completely different rails than, let's say, Schwab or Fidelity, one of the legacy ones. Not disrespectfully legacy, but the ones that have been around for a long time.
No, makes sense. Yep.
And I don't think that they will have an easy way to like migrate into completely new cloud-based infrastructure like Robinhood has. And the same thing, if Robinhood wanted to move into completely new blockchain rails, it will have a problem, right? So it's much easier to think that there will be Coinbase or somebody has been, designed from the ground up already on blockchain rails that will actually occupy that space in the future.
No, it's an interesting point. What I was going to interject earlier is that I think a lot of people in this, listening to you, will find given that you're the CEO of a tokenization firm that landed probably one of the most high-profile collaborations in the industry, that you still have, dare I say, rational exuberance, with a nod to Mr. Greenspan,
I think
around.
I've been myself in the industry way too optimistic, way too early. And I'm probably more of a, as you said, more rational, because I've seen firsthand how complicated. We've been in projects with large banks, without mentioning names, where we've looked at how inefficient their systems are. And by the way, when you go into a bank and you try to figure out how they do, like, I'll give you an example. We did a very large study about how commercial paper is being traded. Commercial paper is huge. Banks trade a lot of commercial paper, etc. And then first, it's very complicated to understand how it works, because nobody knows how it works at a bank. Like, there's this guy that knows how it works, whatever he does, like the trading, and then this guy knows how the payment agent works, and this guy knows how the custodian integration works, and like, so putting all these pieces together about all the disparate part technologies together to understand the entire flow is very complicated. And when you put it together, you're just like, wow, I can improve here. There's like 10 different places where putting everything on a blockchain will improve. But now when you go and think about how am I going to do this, it's just impossible, because you will have to displace all this infrastructure and all these intermediaries that have been built for over the years to basically run that process end to end. So I think it makes more sense to think like there will be new issuances of commercial paper that are completely separated, that will be on blockchain rails natively, completely separated, and not try to like change that infrastructure. And then of course that infrastructure, since it is more inefficient, over time will shrink, and then the volume will move to the new infrastructure, right? Which is what has happened, if you want, with mainframe versus cloud-based, but not because you're going to replace it and the same volume will just migrate to a new technology.
I'd be remiss if I didn't ask you this question, seeing that we are speaking under the banner of the Bretton Woods Committee. We're 80 years removed from the end of World War II, 80 years removed from the original convening in New Hampshire at Bretton Woods that created the Bretton Woods institutions. And despite all of the improvements globally that we could talk about, there's never been a period of greater human prosperity since the wake of World War II and Bretton Woods institutions. If you think about the IMF and you think about the World Bank, do you see a future where tokenization is a big part of how these institutions operate? These types of organizations, similar organizations. Are you able to speak to that a little bit?
Yeah, we haven't participated in any of the projects, but I know that they've done pilots of like bond issuances and debt issuance on tokenized rails. I think this could particularly be good for emerging economies that maybe don't have that much infrastructure. The same way that some countries adopted mobile directly and they never went through like fixed line connectivity because they didn't have funds to start with. So, and then they kind of leapfrog one technology step. I think that this for these institutions that do interact a lot with and help emerging economies that probably have less of an existing infrastructure, tokenization, crypto, etc., could actually be a way to kind of like move people forward, bypassing something intermediate, right? Like in the US, you have very efficient payment mechanisms, right? but that doesn't exist in other countries. So maybe those are opportunities of, some of those countries to just go directly into the newest generation of technologies that facilitate financial inclusion and financial services, tokenization being one of them, right? So I do think that those institutions could actually play a big role into spreading this to emerging economies, yes.
I'll go one more question before we open it up to the audience, if I can. So, Zach, I'll just cue that up for you. But I wanted to talk about kind of where you see this intersection of tokenization, and you mentioned stable coins before, and maybe can you speak a little bit to that nexus, if you could?
Yeah, as I mentioned, I think that having tokenized dollars and tokenized securities on the same ledger is a huge advantage, right? Because it allows you to basically settle a trade without counterparty risk, because you can basically swap the two assets, which is impossible in traditional finance, right? And then tokenized dollars is the biggest use case of tokenization today. There is $150 billion. Tokenized treasuries, which is what we're doing with BlackRock, is still tiny. It's like $2 billion. And it was $1 billion 140 days ago. And we have basically...
It's growing way faster. It's growing way faster, isn't it?
And it has to grow faster, right? Because if you think about the amount of deposits, which you can think of a tokenized dollar as a deposit or an actual dollar versus treasuries. Treasuries are way bigger in traditional finance. It just happens that in crypto, they started later because you have tokenized dollars since 2014 with Tether, Circle and Coinbase issued USDC in 2019, and tokenized treasuries haven't been a reality until the last, 12 months, pretty much. So they are growing much faster, and they will grow much faster than stable coins and eventually become a really big category. And then you have the next thing, like what comes next, right? So
right,
we're excited about, like, especially in an environment where maybe interest rates finally are going to start declining, even though they're probably not going to go back to zero like we had before, but they are going to start declining. Then anything adjacent to treasuries that has maybe higher yield, maybe a little bit less liquidity is probably the next natural place where tokenization will start playing a role. And I think this, projects that myself and others have tried to do in the past about, like, let's tokenize a piece of real estate, and those more esoteric tokenization projects will take a very, very long time to be a reality and to come into the market. So
terrific. Zach, let me open it up and see, do we have any questions coming in from the audience this afternoon?
Yes, we have one from Antonio. Antonio, I will ask you to unmute yourself so you can ask the question.
Oh, good. Hi, Carlos. Thank you. And thanks, Zach, and thanks, Greg. I can't see my question now because I'm on my phone, but it's basically around this. Increasingly, we live in an international world, right? Greg talked about the time of great prosperity of humanity being very different to the time of the origins of Bretton Woods Committee. As we move forward and tokenization plays a big role in each jurisdiction kind of enhancing the way it's doing things, we can look at an international kind of world where we would want to trade securities across borders. And ideally, we are able to do that, right? We can do that today, but it's cumbersome. Standards like LEI exist, and but that's really for entities. To what degree are those useful to you in what you're doing today, if you were to extend it across borders, let's say for entities? And then do you think that there's a, I don't know, a need or maybe an opportunity to put an international task force together that looks at what the baseline variables would be for individuals and their digital identities, right? So that we can start passing data across that contains basic elements of KYC and that kind of thing. Would just love to hear your perspective. I know it's a far-reaching kind of request.
Talk to things that are completely different. So one is about cross-border trading, if you want, of securities. I think that tokenization has first, I don't think countries will agree on global regulatory standards. I mean, I'm European. We can't even agree within Europe. So imagine if it involves the US or Japan and China. So I don't think that that's a productive discussion. I think it's much better to try to build the infrastructure on top of it that basically complies with all these local jurisdictions in a programmatic way, which is what tokenization will allow you to do. And that will be much faster than waiting for the governments to come and solve our problems. So I'm more in favor of the second. Let everybody do whatever they want. If they agree, great. But I work for a startup. I have a limited time of getting things done, and I can't just wait for governments to get things done. So I think it's easier to just try to build on top and use this technology, which, as I mentioned, essentially provides programmable securities, because securities themselves could be programmable to comply with certain restrictions and transfers and etc., and then use them to provide a layer, software layer on top of existing local regulations that provides a very efficient cross-border trading of securities. So that's my view. The second, about identity, kind of boils down to the same thing. Today, there's no KYC standards per country. Like we run funds, tokenized funds that are in different jurisdictions. Every jurisdiction has a different KYC standard. So we can't even unify KYC standards in our own platform because of BVI is different and Delaware is different and Luxembourg is different and this and that, in terms of how much data you need to collect and stuff like that. And then creating those standards is the first step. But then the second problem is, how do you actually share that KYC data, which a lot of people in the industry are trying to solve, which could be a very useful thing, but again, it's problematic because you're basically taking liability on somebody else, right? So if I take KYC from somebody else and it's not done well, and I end up selling a security to the wrong person, and it turns out to be a terrorist or from a sanction country, or somebody that simply shouldn't be holding the security I just sold, I'm liable for that. So if I rely on the KYC of somebody else, it could be very problematic. And in traditional finance, that's an unsolved problem, right? Like today, you go in the US and you onboard with JP Morgan, with Morgan Stanley, they'll do their own separate KYC, and you will think these guys are in the same country, same regulator, etc. They should be able to agree, so I don't have to do KYC twice, and they haven't done it yet. So it's also probably an issue of competitiveness, right? They see owning the customer data as a proprietary competitive advantage, right? But they eliminating the friction on KYC is huge, because obviously that's one of the friction points, and one of the reasons I think that things like real assets and tokenized securities have taken some more time to penetrate the crypto economies, because there's a lot of crypto that is purely permissionless and anonymous that has no friction. So you're competing with something that's potentially better regulated, etc., but that's friction, right? So
terrific. Thank you, Antonio.
We have another question from Christopher, and then Brandon, I will come to you. Christopher.
Hi, this is Chris Calabia. I'm an ex-central banker, now doing some research with the MIT Digital Currency Initiative. Carlos, I agree with your view that not everything's going to be tokenized at once, and certainly not everything in the near future. So I'm curious about some of the challenges that we face in building on and off ramps from legacy systems to blockchains and back. You've probably already worked on that a bit. Like, what are the big things that the industry and maybe regulators need to think about?
Yeah, so this is a problem because it's not just building the bridges, it's just because the two systems don't work at the same speed, right? And we face this problem with a tokenized money market fund. So if we want to do a redemption in USDC, we can do USDC on chain, and it's instant. But then obviously you're not really redeeming the underlying fund; you're just basically moving the ownership, etc. But if you want to really redeem it through the traditional finance, then it means somebody has to sell those treasuries, then wire money, and then that money needs to arrive to another bank account, and then you need to convert it to a stable coin and then send it, and that adds the friction. So I think that this is why I think that there isn't a scenario where these two things are, they have bridges like what we do. I see myself as a bridging between TradFi and crypto, but those two things kind of grow separately, right? Because sometimes trying to merge how the speed of one thing with the other one is very difficult. So
thank you very much, Christopher.
Great question, Chris. Yeah.
Brandon, we are coming to you, and then Mahesh, I will come to you afterwards.
Can you hear me?
Yes.
Yeah, sure can.
Hey, Carlos, it's Brandon Neal. I'm also a former New York Fed person, and I'm now the COO over at Euler, which is, you might have heard, it's a DeFi money market on Ethereum.
Okay, for you guys, right? As far as I know.
Right, yeah. I was curious, one of the things I keep thinking about, and I've got my own theory on it, but I'm really curious to your view and outlook, is like various jurisdictions recognizing blockchain or DOT as a legal record of ownership versus just a secondary record that sits on top of whatever the transferred agent holds. So that if there's ever a dispute, or if there's like it goes in front of a judge, they know, okay, this is sort of a bearer instrument that this person is recognized as owning by the blockchain. And the reason I ask that is because in the context of DeFi, as you're well aware, one of the coolest use cases is to post tokenized US treasuries as collateral and to be able to borrow against those. Of course, if your position's underwater, then a counterparty, someone in the market should be able to take that collateral, and it should be legally recognized as theirs based on the smart contracts. And Greg, to answer your earlier question, the smart contracts work perfectly around this stuff. It's, I think, this like legal clunkiness that there needs to be more clarity about, and I'm curious to hear Carlos's views.
All right. So you've asked three different questions. One is,
sorry,
the ledger an admissible record of ownership. The second one, are these bearer assets? And the third one, can this be used in DeFi? And third, if they use in DeFi, how you liquidate the collateral? So those are different problems. So first is that we operate a transfer agent. That's an SEC registered transfer agent. We're the largest one that uses blockchain in the space. I actually bought a traditional transfer agent to get expertise on transfer agency, because that's not my background, that's not my thing. So I needed to have somebody that knew how to operate a transfer agent. So we actually have two licenses, the one that I filed from scratch, which was native blockchain from the beginning, and the one that they have. I can tell you, on transfer agency regulation, there is no one single mention about what ledger you need to use. That doesn't exist. So this thing that, oh, well, they don't want you to use a blockchain as a ledger. Well, there's no place in the entire transfer agent regulation that says what ledger can you use or not. I mean, I could use whatever I want for that matter. So this misperception that you can't use a public blockchain it's just basically, a position that the SEC has taken because they have concerns, in some cases, legitimate concerns about, how blockchain is being used and how crypto and things like that. And they're concerned about using this new technology as a financial services infrastructure, and what happens if it disappears, what happens with the record of ownership of things, etc. But the same thing happened when cloud started, and people had concerns about it, etc. But from a regulatory perspective, there's nothing that tells you what ledger you need to use. You could use whatever you want. And in fact, there's a lot of transfer agents that use very, very shitty ledgers on very outdated systems, completely centralized. They're more prone to failure than a public blockchain. And that has been our battle, right? Like, we want to use this ledger. There's nothing that should prevent us from doing it. And ironically, Chair Gensler takes the position that, you shouldn't be regulated by the technology you use. And that's what it tells the crypto people. They should abide by the existing securities regulations. But then for the traditional people, that traditional licenses that want to use crypto, they're trying to regulate us by the technology we use, which is a bit ironic. So that's the first thing. Now, the problem is that a blockchain is not a complete ledger for recording everything that me as a transfer agent I need to record, because I need to keep track of not just the balances, but also the personal identifiable information of the investor. And blockchains are not a good place to put that information there. It could become visible, it's clunky, etc. So we keep a mapping, let's say, of wallets to investors that is off-chain. But the ledger we use is the blockchain. The blockchain is wallets and balances of each wallet that represents the ownership of that particular security for each investor. Now, the tokens we issue are not bearer assets. That's a misperception. Bearer assets are not used for securities in the US. I think they're for the most part banned for good reasons. So they're not like crypto assets that are completely bearer assets. That's a misperception as well in the industry. We do have the ability as a transfer agent to burn the asset, to reissue the asset, to freeze the transfer, etc., if required. Of course, following existing regulations, like a traditional transfer agent does it, right? Like a traditional transfer agent will be able to, reissue a share certificate if somebody lost it, and after validating the ownership of the securities by an investor and things like that. So they're not really bearer assets. So that's the second thing you asked. The third one about interaction with DeFi. The problem with interacting with DeFi is the permissionless and anonymous nature of DeFi, right? Because these things are securities, and therefore by nature, they need to be transferred to a lawful owner of the security, somebody that can actually hold that security. And the same thing with the liquidation process, right? Like if you're going to liquidate the security and you're going to take possession of it, you need to be somebody that can take. I cannot allow somebody from North Korea to take possession of a US tokenized treasury fund because that would be illegal, right? So
not helpful.
Unless DeFi has some degrees of control And as you know, we're trying to figure this out with companies like you and others, how these two worlds interact, the whole completely permissionless anonymous world of DeFi with the permission and KYC world of securities. This friction will exist. I think my view is that the same way that all centralized exchanges in crypto do KYC today and track transactions, the same thing will happen in DeFi eventually. And it will still be a very, very useful piece, infrastructure. But this permissionless and anonymous nature of DeFi is not a scalable solution because it prevents a lot of actors from actually interacting with those protocols.
Terrific question, Brandon. Thank you. Mahesh, I think we have time for one. Real quick, if you can, Brandon, and then we'll get Mahesh in, okay?
What's your view, Carlos, of on-chain bearer assets such as USDT and USDC having yield sort of bleed through to them through DeFi? So there's like a permissioned walled garden portion of DeFi where you can hold treasuries, and that yield bleeds on-chain into people who haven't, gone through a KYC or a permission process.
That's what I said, right? Like, so first, USDC and USDT, they don't give you the yield directly because otherwise they will, be selling securities. And that's why they keep the yield for themselves, which by the way is a really great business model for them as well. So I think that there is a lot of, now attempts from different industry players on creating yield-bearing stable coins. I think that they will be crossing, very, very close to what regulators don't like, because those probably are securities in most cases, and some of them are trying to issue them as securities, at least in the issuance and the redemption, but not in between, etc. So they're trying to be creative with things. Now, and DeFi itself is the same thing. Like, I don't think governments will allow anything that is completely permissionless and anonymous, because it very naturally leads to problems with financing of terrorism, illicit activity, etc. So DeFi today is very small, nobody cares. I think the regulators are more concerned about regulating centralized trading venues and other parts of the crypto space. As DeFi grows, if it grows without the participation of TradFi firms that will not touch it as far as it's completely permissionless and anonymous, will eventually attract the attraction of the regulators, that they will try to put control over that. Because when you're trading on DeFi today, you just don't know who your counterparty is. I mean, for all you know, it could be somebody in Hamas that is just borrowing USDC from you, right? So
right. On-chain bleed does sound like a heavy metal band name too, by the way. It occurs to me. I just thought I would throw that out there. Mahesh, maybe we can get one more question in.
Thank you. I'll make it concise. First, thank you very much, Carlos, and also Greg, for bringing somebody who is in the middle of it to make things a little bit, demystify them. It's been very helpful. Let me just ask a generic and a broad question. From where you sit, based on the experience you have had with the BlackRock fund and more generally in the blockchain and crypto area, what are the three risks that concern you the most? You are sort of sitting where the rubber meets the road. We hear a lot about risks from the people who know regulatory business, and sometimes they don't understand the technology. So I'd like to hear from the guy who knows the technology, what he thinks are the top three risks that you're most concerned about in this tokenization area.
I'm not that concerned. We use the public Ethereum blockchain, which is probably a very, very safe place to operate in terms of like being hacked or having problems. As you trickle down into other blockchains, then obviously you start assuming a little bit more and more risks, because they're smaller, they're less decentralized, they're newer, etc. I'm less concerned about technology risk. I'm more concerned about bad actors risk, because we did a project with KKR, which was the first tokenized fund from a large asset manager, and then we did another one really quickly with Hamilton Lane, and then we didn't do anything for a year and a half. You know why? Because of all the shenanigans that happen in the crypto industry. BlockFi, Celsius, FTX, and so that to me is the biggest risk. It's like, if the crypto community doesn't behave and try to abide by the law, and there's some big blow up of some illegal activity, illicit activity, or like financing terrorism or things like that, then this will scare the TradFi people and will set the industry back for a few years, and it will obviously affect me. Because today the reality is that these things don't move the needle, right? They're not big enough for anybody on TradFi to care. People in crypto care, but because crypto is a smaller economy, right? But nobody in TradFi really care. They do it because they believe on the future. But if this has an impact into their, level of risk or corporate reputation, etc., they'll just pull out and wait. And that's what happened for a period of time. And that's the biggest, in my opinion, risk of the industry. Our industry, before it gets regulated, should self-police themselves a little bit more and not allow bad actors to emerge, because that's probably the biggest risk the industry has today.
Mahesh, what a terrific question for us to end our conversation with. And how ironic that the wisdom of grandmothers, one bad apple spoils the bunch, actually carries over to the tokenization industry. Carlos, on behalf of the Bretton Woods Committee, thank you very, very much for spending your time with us this afternoon and sharing your insights on a subject that has such great appeal and promise. Thank you.
Thanks for the invitation, Greg, for the insightful interview and for all the questions. It was my pleasure.
Safe travels, and thank you, everybody. Zach?
Thank you.
Bye-bye.